Hey everybody, welcome to this webinar. This is Shane Smoleny from Wolftrader Futures, and this is going to be a live stream on how to profit in the bear market. So I'm just going to do a few sound and audio checks here and we will get started. So just let me know in the comments if you can hear me okay, and can you see me okay, and we will get started. So we're going to do a little bit of a specific market today about the bear market strategies that you can use to trade in. And this is a little bit of a different webinar because I'm going through 12 tips. I originally started this as just a few. It was 10, and now I have up to 10 different tips here for the bear market. So why am I talking about this? Because I believe we're in a bear market, and it's very complex because of the Fed and everything that is involved with the Fed. So I'm trying to give a big perspective today and just some kind of practical applications in terms of how this could unfold and then how you can profit from it. And everything from the big astro picture to the big Fed picture, getting all the way down to psychology, down to, you know, types of positions you put on and what you should expect and limitations that you can set upon yourself. So let's get started here. So great, everybody can see and hear. So first of all, I'd like to go through the contact information. If you guys need to reach me, you can reach me at shane@wolftraderfutures.com or www.wolftraderfutures.com. This is the website here. It's also www.fedjuice.com. And our YouTube is Wolftrader Futures, which is where you are now. And then Twitter, there's a live Twitter feed. That's a free Twitter feed, not the platinum Twitter, but one that you can sign up for. Anybody can sign up for. It's at Wolftrader FUTU1. So I post a chart of the day there pretty much every day, and I put information about upcoming webinars and things like that. So it's really a good place to just get some notifications. There's also an email list. If you can sign up for that on the website, you get email notifications and just kind of alerts in terms of what's going on. All right, so we are gathering more and more people here. So for those of you just joining us, I'm Shane Smoleny from Wolftrader Futures, and we are talking about how to profit in the bear market. And special thanks to our moderators, Pat and Ron. They really help us out here with keeping the flow of things going. So thank you so much for our two moderators. They really help the process out here. So we appreciate everything that you do. Just to give you a little bit of a background about the service, there are many services that we have here. So we don't just talk about the S&P. We're going to talk about that today. But we also have the S&P. We have metals newsletters, which is dealing with gold, silver, copper, and platinum. These have daily Fed juice updates along with the S&P. Energy, which has been doing very well, especially with the oil, which I'm going to touch on a chart at the end, is dealing with live Fed juice on natural gas, oil. We have heating oil, and then also gasoline futures. Currency newsletter. We have live Fed juice on many different symbols. We have the Canadian dollar, we have the US dollar, we have the euro, we have the British pound, we have the Japanese yen, Australian dollar, and the euro dollar. So there's a lot to follow here. The cryptocurrencies, we have Bitcoin, Ethereum, Ripple, Litecoin. The Uranian letter is a astrological based letter. This is really just more for people who are interested in astrology. It's a different type of astrology. This is a more complex system that was developed in the early 20s by the Germans, and we talk about different events going on with astrology. It may or may not be related to the market. Sometimes I do talk about the markets, but it's relating to people and charts and things like that. So we talk a lot about the midpoint structures of planets. So it's more of an advanced astrology newsletter. The stock ETF service, this is a new service that we started, and we deal with multiple stocks and ETFs. And right now we have 7 different stocks and ETFs that we're tracking, but it's going to go up to about 10 probably. So we have Apple, Tesla, Broadcom, Caterpillar, Bank of America, Volatility Index. This is doing well, and so this is the new up and coming service. So this has really been, I would think, outperforming my expectations because anytime you start something new, you're not really sure how it's going to go. So we started with this. So what's up, Gary? Good to see you. Hi, Gary. Just some of our subscribers popping in here. So just to let you know, that's what's going on. These are the individual newsletters, so you can subscribe to any specific market that you want. You don't have to get them all, but if you do want them all, the gold membership gives you a very, very nice bundled rate, a bundled discount rate on all of these newsletters. So it's a good deal. These rates are going to be going up. I'll be talking about that in just about 20 days, 21 days. So this is a good time to check it out. We do have a platinum membership, which is a live feed. This is dealing with a live Twitter feed. This is different than the one that I talked about. The one that I just talked about was the free tweet, the free feed. This one here is different. This is to give live market commentary throughout the day. So this is at Wolftrader1, and that is for the platinum subscribers. So we talk about all the trades that we do in the day, market perspectives, charts, intraday charts. There's just a lot going on there. So if that's something you're interested in, you might want to check out this platinum service. We also have trading services. We do option spreads. We have the Fast Fed 2.9, which is coming online now. I have a lot of symbols coming online, which we'll get into that. There's an easy timer, which trades shorter term time frames. This trades every single day, long and short, on each symbol. So for gold and the S&P, this trades long and short every single day. This is a very, very small trading range, maybe 5 to 10 points on the S&P, 2 to 5 points on gold. The Fast Fed the Fast Fed big runs here. This one trades, 100-point type trades on the S&P. These are big swing trades. These are smaller trades. We have pairs traders between corn and wheat, and then we also have the British pound and the Japanese yen. So there's all of these services that are live trading services throughout the day. This is the platinum service. Now all services here are grandfathered in for platinum subscribers. So if you're a platinum subscriber, whatever service that I add on, you'll automatically get it. So that's the cool thing about being a platinum subscriber. So if you get on now at the rate that you're at, your rate will be locked for life. It doesn't change. And so pretty much all the services work that way. If you sign up for a service, you're going to lock your rate. And these do go up. They're going up in October, like I said, because we're adding more features, because we have more services, because the forecasts are getting better. These go up in proportion to the amount of information that we're releasing out. So that's what's going on with that. So if you're interested, check those out. You can go ahead and check them out at the website, wolftraderfutures.com, plan pricing, and you can check those out. There's a 7-day trial on any of these. Quick disclaimer here. Trading commodity futures is risky, especially in a bear market. We'll get to that. Past performances are not indicative of future results, so things could be going well. You can have track history, everything could be great, and then things can stop working. That's just the nature of it. I mean, that's not always the case, but sometimes it is. Sometimes indicators get wonky for a while, and then they come back together. That's just the way that it is. No particular trading system or service works perfect all the time, and that's just the nature of the business. This is an educational service designed to be a supplement to the book that I wrote with Larry Pesavento, A Trader's Guide to Financial Astrology. So this is really educational based. We talk about just approaches, general approaches, understanding the Fed, understanding cycles. And so these are independent of any strategies that I apply at my firm, which is Trading Ridge Analytics. This is a separate firm. I'm a registered CTA and CPO. So what I talk to you about today has nothing to do with a portfolio that I'm managing or anything like that. These are separate because the two can't be related, right? So you can't have subscribers getting information that's in a fund that I'm managing, okay? It can't work like that. They're separate. So the data used in this creation is it's public information. Everybody gets it at the same time. So everybody gets the information at the same time. I don't give one subscriber one set, another subscriber another set. Everybody just gets it. This is a newsletter service. I don't know anything about your account, anything about your situation. In fact, it works better the less I know about you, because the less I know about any of your situations, specifically, I'm not talking about generally, but specifically, the better my forecast can be, because I'm unbiased. Like, the less that I know, the more I can just call the markets clean without having any emotional attachments to anybody's situation. So I really don't want to know the situation. And I do find that the forecasts are better uh, the less that I know about you in terms of what you're doing. Okay, so it's just the way that it is, and that's how newsletters work. They're just, I don't know anything. Here's a newsletter. You subscribe. Everybody gets the same thing. There's no tailored advice. There's no specific advice for your account. I'm not managing anybody's accounts here. It's just here's the information. Do what you want with it. Okay, so that's just kind of to make that clear. Warning about using fragments. This is more important than ever, especially since we are dealing with the Fed that really slammed it hard here to try to really try to intervene on this market. The Fed has really ramped the juice here in the last few days. I'll show you on a chart. It's really incredible. It's the largest spike that I've ever seen in the shortest period of time. The stock market was on the brink of collapse, and they came in and surged the juice to save it. But ultimately, I don't know if they're going to be able to save it in the end. But we'll talk about that. But if you saw from last Saturday to today, the Fed juice looks completely different. Like they've just surged this thing. Not enough to put it into a buy, but they are trying to stop this decline. Believe me. And when you see the chart, your jaw will hit the floor because you will see what they did in response to this. So you get these gaps of information. So you see something today, it's different than next week. So this is why the day-to-day is important. This is why it's so important to get the daily updates on the newsletters. So all the newsletters come with daily updates on the website in addition to a monthly subscription. So you get a monthly newsletter and everything except for the stock ETF. The stock ETF is a daily service, but for S&P, for metals, for energy, for currencies, for cryptocurrencies, you get a monthly newsletter with all the big cycles, but then daily updates too on the website. So it's important because man, this market is highly dependent upon what the Fed is doing, and it makes it really you get into like game theory. Like you're trying to figure out like, okay, if the market goes here, what is the Fed going to do? If the Fed reacts, what is the market's reaction to the Fed? And we'll get into that. Terms of service, I never share your personal data or information. I've been approached many times to sell your guys' information to attend seminars or webinars or whatever. I'm not going to do it. So that's just what it is. I kind of really don't like that personally when my data gets shared. So I'm not going to share other people's data. Okay, that's just what it is. So if you sign up for a newsletter or an email service, that is never going to go out to somebody in the public or anything like that. So you have to physically sign up or you agree. Like, so you say like, I agree to get emails. So sometimes if I go on a show, like the Money Show or something, you have to like agree to put it on a list, but I'm not going to do that without permission. Customers can unsubscribe at any time. So look, if you don't want the emails, if you don't want the notifications, just click unsubscribe and that's that. So each service is monthly. There's none of this annual contract, none of that stuff. It's just monthly, and that's just what it is. So the main thing is that you understand the risks that are involved. This is tough business, forecasting the S&P particularly, but any market, it's tough, it's risky, and it does, even though we have had success, it still comes with high risk, and it comes with how you set up your trades. Like two people can be doing the same trade, and one person can lose money, and the other person can make money because of the way that they set up the trade. Okay, in terms of risk profile, vehicle, all this stuff can determine that. So that's really not something that's something out of my control. All right, so news and events today. First thing, I started a user guide. So I had a lot of requests for people to say, is there a user guide for the service for the site? So I do have a video area where I start putting videos up about how to use different services and indicators, but I started a user guide. So there's a Q&A format where I do questions and answers, and I'm going to start putting links to videos in that. So it's going to be almost like not a blog, but just like a long list of questions and answers. So you guys can go and see that. We'll get into that. We started trading vertical spreads. We haven't traded it in the last week or so just because of what's going on with the S&P. But that has something that has been started. We have this new resolution that we're working on with the Fed juice. I think it's really improved Bitcoin, and there's a lot of other symbols that I think are doing a lot better with it. The S&P and gold Easy Timer. This is the 24-hour-a-day service that I talked about. It tells you ahead of time when the trades come, so you don't have to wait up. It tells you exactly the time it's going to be ahead of time. So, like I'll know right now what the trades will be Sunday night because it's based upon a cyclical time pattern. They're starting to perform well. And I changed the technology to this big runs technology. The profit curves are starting to look a lot more linear and starting to rise. So that's what we want to see with that. This is really tricky business, guys. When you're getting into intraday trades, you're trying to trade, within predict the hour that the trade's going to happen, and with the stops and the limits. This is really tricky, but it is trending up now. They're trending up. We've had a lot of strange periods here with changes with what the Fed was doing. And there was like a 2 or 3 year period where this thing just ran almost linear, like easy. And now it got a lot tougher, but I think we've adjusted. So I'm happy with that. They're on the move. The big runs, that more and more symbols are coming online. So we have a few online now. There's more coming. I think this system here, the big runs, has the most potential. We'll see. We'll let these trades unfold. We are in a chaotic time right now, but I think this has the most potential. We'll see. Streaming crypto is here. So again, I'll be adding probably Ethereum next, but that's something that's going to be a big deal for us too. Now, the October newsletters are out. Obviously, it's October the 9th, but you might want to check those out. This is the time to do it. If you want to do, you get your 7-day free trial. So go ahead over there and check it out. And then I'm working on the live streams on the website. I'm not quite there yet. I like this setup that we have here on YouTube. I think everybody's in the routine. Everybody understands what it is. It's 1 o'clock. It's Saturday. We show up. I put all of this stuff. So I'm not looking to replace this, but I'm looking to add on to it. So like for subscribers, if I want to do a quick live stream, let's say the market's crashing and I want to kind of talk about resistance and support lines and Fibonacci extensions and retracements, all that stuff. I would like to have a forum that we can do that in private for subscribers. So that's what I'm working on, and so that's in the works. But don't worry, it's not going to replace this format. I'm very happy with this. Like I said, I think we're all in a routine now, and getting in a routine is a big part of everything in life. So I'm not somebody who likes to disrupt routines. It took us a lot to get this rolling again and to get this going. So. Okay, so news and events. So stock ETF service is established. When I say established, I mean it's performing, it's doing well. I'm happy with the way that it's going. Of course, there's always tweaks that we have to make and updates, and I'm working on that stuff all the time. But there's a rate increase coming on 10/31. So if you want to lock in the rate, if you're looking for a deal, like in terms of like, I think these are all good prices, especially the S&P, especially the stock ETF, but the metals too. But this one in particular, since it's new, we started it out at $59 a month for non-subscribers, $49 a month for subscribers. This is a good time to try it out. There's nothing to lose, guys. There's nothing to lose by trying it out at 7 days. Try it out, look at it, because the price is going to jump. It's going to jump a lot in October 31st because it's established, it's doing well. I am working on getting an actual track history, a combined portfolio, because I want this to be, the whole point of the stock ETF is that this is like a portfolio that you look at with all of the symbols acting as one, but they're all heading up. I mean, there's been a couple symbols here, like Bank of America and Tesla have been drifting against the Fed use for a few weeks here. But overall, if you looked at all of them on the whole, they are doing very well. Okay, so I will have that. It's coming, but in terms of the track record and the history, but they are climbing. This is moving forward as a portfolio as a whole. It's doing very well. I'm very happy with it, and so just to let you know, this is coming. So I'll try to give everybody enough notice ahead of time before these things go up. But I want it to be fair. I want the pricing to be fair to reflect the amount of information you're getting, the accuracy of what you're getting. And so it needs to be proportionate to that. So if I started with 3 symbols and I'm up to 7 symbols now and there's more information, the prices need to reflect that. So everything needs to be proportional and balanced to what is being offered. Okay, so just to let you know. Now this is the S&P here. These are the S&P, the status of what we're doing here. So this is the status report here. So Fast Fed 2.9. Um, this is the big runs. So this is the status symbol here. The S&P status is online. The oil status is online. The gold status is online. So these three are now up and running. So these are running. Corn is coming Monday, and I'm looking into these other ones over here: Bitcoin, Euro, Canadian dollar, natural gas. So I'm looking into these coming online soon. These are currently offline. This font looks weird. I don't know. I had a different font before, so that's why it looks kind of strange with the font. But these I'm looking to bring these online. But right now, S&P Gold, Oil are online. And for those of you interested in the auto trading, so here's a big thing here. So this is a new algorithm with the FastFed 2.9, the big runs. Like I said, I feel that this has the most potential of any system we've ever rolled out. For the auto trading, if you're interested in that, auto trading is where your account is controlled by a third party and I send the signals. Okay. So I originally was just going to do gold on that, but I'm thinking about combining maybe 2 or 3 symbols on the auto trading. So S&P oil and gold together to run as like a trio. I'm thinking about doing that because I think that that will balance out any drawdowns or, these markets are relatively uncorrelated. I mean, oil and gold, you could say they're inversely correlated, but I think this might be a good one to look at for the auto trading. So the auto trading right now is just gold, but I'm thinking about, like I said, adding these three together. So that's online now. That's with the platinum, and so we have these positions open on S&P oil and gold right now. And like I said, corn is coming online. Corn is ready. We are looking into Bitcoin because Bitcoin has a micro contract now. So that's coming. I'm researching that. I don't know if it's coming, but I'm researching that. Euro, we've done it before. Canadian dollar, we've done it before. Natural gas is a little wild right now. So that's why I swapped it out with oil because there's a micro contract on oil. And because these trade with such huge ranges, we look at the micro contracts because, look, you got to be proportionate to what's going on. If you have very, very big runs, you got to trade with smaller sizes. That's just how it is. Uh, Day traders that trade very small scalping trades trade with huge position sizes. That's just what it is. So just to let you know again, these three are online now. So if you're on the Platinum service, you can see these trades are open. And uh, gold has always been the best one. So probably we're going to have the three of these together on the auto trading. And so if you're interested in that, let me know. I do have a track record on the gold when we were with Striker. I'm no longer with Striker. But if you want that, I can provide that to you, but you have to send me your information. I got to get an email. I'll send you the email. I'll tell you everything to how it works. But the system now, I think, is much better than the one that we were running at Striker. I mean, the one at Striker, it made money. It was modest. It kind of chugged up higher. But I think what we have now, the potential for this is much, much, much better than what we were looking at before. So that's what it is. And like I said, this is going to be, the idea, my vision is for this to be like our marquee trading system. This is like the featured system in terms of trading swing trades. This is what this is how I see it. We've had kind of ups and downs with this. It started really strong last fall, and then it kind of drifted down. And I have revamped everything. And this is when I went away from Striker, and I said, okay, I'm going to rethink this. What was working back in October and November, what wasn't working. So I took all of this together and we came up with the big runs. And I think this has potential, but we'll see. But that's what's going on right now. So just that. So let's get to the topic of our webinar here, which is key tips to profit in a bear market. So I believe we're in a bear market. I know there's other definitions of a bear market. You have to decline X percent or 15 or 20%, whatever it is. That's fine. But from what I'm seeing in terms of the Fed, I think that we're in this. And so I'm going to give you my tips here. Like I said, there's 12 tips, 12 important tips. There's more. Maybe I'll do a part 2 to this video. But this is just what I feel is important. Looking back on everything from wisdom from the past to current wisdom with what's going on with the Fed. Okay, so here's our first tip. Key number one is follow the Fed juice. Okay, so this is a picture here of the Fed juice in the background. We'll talk about this in a little bit. This is the Fed juice here. This is the S&P, and essentially whatever this Fed juice does, the S&P is going to follow. Now, the Fed juice dictates the long-term flows in equity markets. So when you're looking for long-term patterns in the markets, this is really important to follow because in this modern day and age, this modern banking era, the Fed determines what's going to happen with the market. Um, if the Fed pulls back and does taper, then these markets will suffer. So there's a lot of political pressure right now on the Fed to taper. So this is not an ideal time for them to be seeing a declining market. They would not, this is not their preference to see this situation where they're under pressure to taper and yet here comes the market. Now there were very, very short-term things that they did here. They did respond to this market very quickly when it started to decline. This is what I talked about with the gaps of information. If you tuned in a week ago, this was a very different looking market than it is now because the Fed has spiked this. But the damage is done, I think, from this huge pullback that they've done. And then the question is, are they going to continue to ramp this? My guess is no. With the political pressure that they're seeing, they're going to be under pressure not to keep ramping this up because of the inflation problems that we're seeing. So that's the first key. Follow the Fed juice. This is important. We're the only ones that offer the Fed juice. Nobody else offers this. This is a registered U.S. trademark. I've gone through lots of work on this to make this very, very um, proprietary in terms of what we do, in terms of how we measure this. There's like 4 different ways that we measure the Fed juice. So nobody else does this. So I would recommend that you follow the Fed juice here, okay, if you're interested in what's going to happen with the S&P on the long term. Now, next slide here. So this is important because we need to monitor the relative strength of the Fed. So why is this important? Well, first of all, the Fed is always acting on the markets, okay? No matter what, they're always intervening in markets. They're trying to provide liquidity, and they have all these different facilities that they do, but they're always acting, okay? The key is to monitor the relative strength of the market to the Fed. Now, so far, since 2009, the markets have pretty much gone along with the Fed. When the Fed increases, the market goes up. When the Fed pulls back, the market pulls back. The key is that what happens when you get a situation where the market is the Fed is increasing, but the market is barely going up. So you might say, well, that was a really strong rally we got on on Wednesday and Thursday. But the question is, compared to what? Look at how much energy the Fed had to put into this, right? So when you're talking about things like why can't we go faster than the speed of light? Because the energy is infinite to do that. Well, at some point, the Fed's got to realize that if they have to put an infinite amount of energy into this to keep this going up, that's not good either. So we look at I call this the calculus of it. So we got to look at the overall Fed. What is the Fed doing? And then how is the market responding? Okay, how is the market responding? So Gary Investment, where are the Fed changes posted on the site? They're posted on Twitter and the closing bell. Okay, just answering a question there from Gary. Gary's question was, where are the Fed changes posted on the site and when? So the Fed changes are posted on Twitter, and they're posted on the closing bell, and they're usually updated after 1 o'clock. So I send out a remind text to everybody, hey, look, the markets are updated. Usually by 1 o'clock. During the financial crisis of 2020, I had to wait until like 3 o'clock because they kept acting all the way to the very end of the day. When they get into these wild ranges of like 90 billion a day, it's hard to know. Some things that they plan out, they tell you when they're going to purchase things and they give you schedules. Other things they don't. So it's hard for me to know in a period of a crisis until maybe 3 o'clock, but we're not really in a crisis yet. So right around 1 o'clock, maybe 1:30, I usually know what's going on. So that's what's going on. So this must be taken into the calculus. In severe times, the market may lose the ability to respond to the Fed. So this is what I think we're starting to see now. So when I talk about the calculus of this, I'm looking at the whole picture. Is the Fed responding? Yes. Did the market respond? A little bit. Should the market be responding more? Yes. The market should have been responding much more than it did. And that's where this gets complicated because it's like we're in this modern area of game theory. Okay, if the market goes here, what's the Fed going to do? And if the market doesn't go up as much as they want, all of this stuff comes into play. So that's where it becomes important to look at the relative strength. I don't think it's very strong relative to what the Fed is doing. All right, so this next one here is tip number 2, monitor the double lunar cycle alignment. I really, really like this indicator. This is the double lunar cycle that we put up for most symbols. It gives you a very nice backbone. You can see here, going back into this July, this is just like a little snapshot here of July. I know these charts are more like artistic looking today, but this is the double lunar cycle declining here, and you can see the market followed it down here. I like this because it lets you look out into the future to kind of know what is going on uh, into the future to kind of forecast. It's not always perfect. There are times when it can be off here, like in August, it was a little bit off. It was already increasing when this had this August decline here, but this big decline in September, the double lunar cycle picks all of this up, and you can see the market follows it down. And then there was a spike here, and the market spiked up, and then it falls back down here. So as a general backbone, I like it. I think it's a good dipstick indicator. When I say dipstick, just to kind of when I'm looking at a graph, like one of the first things I like to look at is the double lunar cycle. I like to just look at it and see what is it doing, especially on like gold and silver and a lot of these metals. They follow this double lunar cycle beautifully. Oil does too. But I like this. So it helps you understand short and medium term forecasts. Now, a forecast is not the same as the Fed. The Fed is kind of like, I have to wait and see what they're going to do, and then based upon what they do, we get a signal. This is different. This is predestined from the beginning of the month. Like we already know what it's going to look like. So when you get this double lunar cycle, I really like it because it gives you a roadmap of what you can be expecting to play out in the month, which is big. I don't have that with the Fed. I got to wait to see what they're doing. And you saw what they did in 1 week. You saw this with the Fed. They did this in 1 week. There's no way to forecast this. This bounce in the S&P was entirely based upon what the Fed did. Okay, there's no way to forecast that. There's no way to know what they're going to do. I can't forecast what the Fed's going to do, but I can take what they're going to do and kind of put it into a neural network and give you the Fed juice. So this helps determine short-term highs, lows, and acceleration points. So if you are declining when this double lunar cycle goes down, the market tends to accelerate even faster. So that would be what I would call an acceleration point, or also the relative strength of the trend. So if it's resisting it, the trend is strong in the other direction. If it's moving with it, it tends to move faster, like I said here with the acceleration points. So just something to think about, but this is a tip. If you're looking on the chart when you're a subscriber, I would always look to that double lunar cycle. Like right now, we're coming up to some type of a rounding top on it. I think it's really important to take a look at that. So that's just a tip. Tip number 3, monitor key astro factors and planetary speed and acceleration index. Okay, we talked about this for the last 2 weeks about market crashes and scenarios. But market crashes always happen around a declining planetary speed index and usually around a planetary acceleration index when you get a really bad decline. So this red line over here is the planetary speed index. Again, we spoke about this last week, but this is really present in all market crash situations. So it's important to follow this because it increases the odds that you're going to see a market crash type of activity. Also, there's planetary transits here. So we know that there's always the Mercury station. We know that there's always the Venus-Uranus. And again, we did 2 long videos about this. I'm not going to go into detail about this, but the point is that when you have a market that's declining around these conditions, your odds of a crash go up. Doesn't mean it's going to happen, but it means the odds go up. So that's an important tip to monitor this. And we do talk about this in the newsletter for the S&P. I try to give the turning points and the dates. We're kind of right in the middle of all of this right now. There's many waves of potential selling coming, but that's a tip. Monitor these. Be aware of the situation. Just be aware of it because it increases the chances that something very dangerous could happen. Okay, and like I said, the last 2 weeks we've talked about this, so you can go back and look at these videos. They're called market crash signatures. I did part 1 and part 2. Part 1 was on the pre-2009 situation, like the 29 crash, the 87 crash, and then I did one after 2009, which focused on the modern era, what I call the modern era of the Fed. So monitor these, okay? Be aware that they're there. Next tip, there is an event horizon in bear markets. So for those of you who don't know what an event horizon is, an event horizon is a point of no return as you approach a black hole where nothing can escape, not even light, nothing can escape. So once you're approaching a black hole, once you get to a certain point, you cannot come out of it. Okay, so this is really important. I think the Fed understands this too. When the market was pushing that 4,300 level, that was the event horizon, and the Fed did everything in their power to stop the market from hitting that 4,300 level. It was like if that market hit that 4,300 or continuously, it did go below it in the futures a little bit, but in terms of sustained getting lower and lower below that, I think they knew that it was going to keep going much, much lower. So the problem is that when you get into these situations, they cause the appearances of a straight path down. So when I say the appearance, we know that nothing travels in a straight line down. It gives the appearance that the market's going to go down to infinity, and that's when the real fear comes in. It seems like it's going to go to zero. It's never going to stop going down. We know that's not true. I mean, eventually markets do bounce, but this is the danger of it. And once the market hits that point, you can get these big drawdowns, these big downdrafts that happen, like we saw in 1929, 1987, 2008. So I think the Fed knows this. They're trying to stall. The infrastructure deal obviously was a big blow that didn't pass, and the Fed was trying to buy time. But I think we're getting closer and closer to this point, and the Fed did rescue us this week. But we're like right there, like we're like right there. And I think the danger of this is once we hit that point, I don't even think the Fed can stop it. So be aware of that. And I think right now the 4,300 level, that's about that point on this. So that's just how they act. That's how these bear markets act. There's magnets. There's certain points to where everyone just kind of throws their hands in the air and throws in the towel, and you can't come back. Okay, so that's why the Fed was so determined to keep that 4,300 level up. I mean, there were rumors and all this stuff that the Fed ordered the banks to do this. The point is, whether they did or not, they know this is important. I think everybody knows that's important. So they're trying to keep this market kind of floating around. I mean, the volatility in the last few days has been incredible. That big bounce that we saw on Wednesday and Thursday was huge. It was just straight up, right? And so that gets us into the concept of the rules change for the bear markets. This is not going to be the same thing that you saw before. So understand that. All right, tip number 5. Fed interventions can and will interrupt straight down paths. Okay? So here's the problem. This is the modern era that we're in. This is the reality. Market can be going down. So this is the event horizon here that I talked about. So let me draw on this so you can see it. This is the event horizon. I think the Fed knew this. So here's this level here. So this is when the Fed really started ramping the juice. Now you saw another graph, the Fed juice kind of just went like this, right? So the Fed comes in, every time it hits that level, the Fed shored this market up. Okay, so the Fed pushes this up, back up to these levels, up into here, to try to get us away from this. But we are still dangerously close to this level. And everybody knows if it gets below that, it's going to keep going down, and it's going to have a downdraft. But the problem is the Fed is a real problem for shorting the market, both the short and the long term, because you can think this market was ready to completely collapse, and then here comes the Fed coming in, wreaking havoc on the shorts, trying to discourage the shorts, humiliate the bears, all this stuff, right? They can even stop event horizons on I would say in the short term. They did in the short term. They knew that was it, right? When they came in right here, they knew it. Right? So that's a problem because you're expecting the market to behave and flow in a certain way, and here comes this external force to stop it. So it becomes game theory. What is the Fed going to do? How many times are they going to do it? When are they going to give up? Okay. Right now they came in and they held it 3 times, but this still looks extremely fragile. They may not be able to do it all the time, okay? But ultimately, and we'll get into this, they will win in the end eventually. So we may see a bear market in the short term. We may see, severe declines in the market, but ultimately, long term, they're going to win. So understand that. So this becomes tough because now you've got to deal with the Fed coming in, and this is why I talked about understanding the calculus of this. Well, the Fed is acting, but how is the market responding? So right now the market is weak compared to the Fed, and this is why the internals have not gone into a buy. Okay, the market is not responding very well. Yes, the Fed lifted us up here, and so people are. If you look at Fibonacci points and you look at retracements, you might say, "Well, that's a pretty good retracement." Not compared to the amount of energy you put into this. Not compared to the amount of energy the Fed put into this. It's not. So that's what I'm saying. You got to look at it based upon what they're doing. If this was the market doing it by themselves without the Fed, I would say, hey, that's pretty impressive. But it's not. This is all the Fed. So not really that impressive, to be honest with you. Tip number 6, flash crashes are a thing and with high-speed trading. So this is another wrinkle here that nobody had to deal with in 1987, 2008 even. It was relatively new. But high-speed computers have created a new reality where prices can dislocate instantly. So this high-speed trading is a problem, okay? So now people have pointed out to me that, maybe these high-speed computers have gotten smarter now, and maybe it's not a problem. Like people have pointed this out to me. Well, in 2010, we got this flash crash into here, right? Which of course it all showed up around all the other market crash signatures, but this was the big flash crash into here. Somebody brought up to my attention, it was like, well, aren't the computers smarter now? Isn't the artificial intelligence smarter now? Yeah, it is. But the problem is that the smart computers during the flash crash, they just shut off their computers. They just shut them off. They didn't want to participate. So whether they're smarter or not, if they turn off their computers and the not so smart high-speed computers kept trading, that it doesn't matter if they're better. If the market makers are disappear, which is what happened in 2010, the markets can drop to, Procter and Gamble was trading almost near zero, right, when this happened. So this is a risk, a very real risk. There have been flash crashes happening all the time in different markets you don't really hear about. Regular stocks, you hear about it, and even recently gold had a few of these. So this is a very real, legitimate concern to understand that this is a thing. And if you're trying to short the market and this type of a situation happens, it might be too late. You might not be able to see what's going on. It can just instantly happen. You can't control it. So this is a risk. And so the reason I talk about this is, one, if you're long, it's dangerous. If you're just kind of monitoring the market, because it can just happen very quickly. But the other one is if you're trying to wait for a point to short the market, it can just go at any time. And so we saw this. We saw this a lot during the advance in the 2020 advance. There was a lot of times where the market was going up and it would just kind of have these big. I called it falling out of the sky. It would just be going up, going up like this, and then we'd just have this big fall like this big fall like this. So we're seeing this more and more now, and I think these are the computers. So this is a thing to be aware of. So it could be too late to try to get into a position, or even stops may not fill. Right? We know that if you have like a really deep stop, it may not fill, it may not trigger. Like it may trigger the stop, but there may be no market there, and you could get filled way below what your stop is if you have deep stops. So just a tip there. That's tip number 6. This is a very real. This is the world we live in now. We have the Fed and we have the flash crash thing. This is all real stuff to be aware of. Okay, tip number 7: avoiding noise. This is a big thing. Dying bulls get very aggressive on each bounce. I've noticed this a lot on message boards. I've noticed this a lot on radio shows. The bulls right now are getting very, very aggressive every time the market moves up just a little bit. And so to me, that's a sign that's a psychological sign to be careful of, because the dying bulls make a lot of noise. So each bounce, they get more and more aggressive. And the thing about bear markets is that these bounces should retrace very quickly. So that's what we've been seeing. They haven't been able to extend up. We did get that one really strong bounce off the bottom this week, but I just showed you that was the Fed. Um, these bulls have been trained for years to feel entitled to easy gains. So I use the word entitled because, hey, I'm just going to put my money in this ETF, and it's just going to keep going up. I don't have to do anything. We don't need to hire hedge fund managers. I'm entitled to this, man. I'm just going to put my money in, and it's just going to keep going up. And so that's a problem because nothing comes easy, nothing comes without a price. You got to be careful about this. Okay, I know it's been for a long time. People have been trained just to throw their money in and it's easy and they're entitled. But when entitled people throw tantrums, okay, so you're going to see the bulls start to throw more and more tantrums here as this goes down, get more and more aggressive. And we see this. I've personally seen this a lot. I also saw this on the crypto. I noticed that the crypto bulls get very aggressive. When we had that big decline in the crypto, anytime it start inching up, they start getting really, really aggressive. So I noticed that that can show up in the place of sentiment sometimes, the aggression levels, um, like where they don't even want to hear that the market could go down. They just get really, really angry. Like, how dare you say that? So just keep that in mind, that that's part of the psychology. They've been trained to buy the dips. Like, just that's just what it is. And it took a long, long, long time for people to feel comfortable doing that, because after 2008, nobody wanted anything to do with the market, right? So it's taken a long time for this to happen. So that entitled attitude, I think it's very real. So I'm just saying, avoid the noise on that. Focus on the charts. Focus, like Larry Pesavento says, trade what you see. If you see lower lows and lower highs, and the market's not able to get up, it's not. I just be careful. Okay, I think we're in a changing dynamic. It's something that we haven't seen, and so nobody's understanding what they're looking at. Okay, in terms of the market turning. Ignore the goldfish investors. So you guys have heard the term that somebody has the memory of a goldfish. Well, many investors, I don't know if I throw this into goldfish or not, but the younger generation, the Robinhood traders, they've never seen a bear market. They don't know what it means. They just know that they're getting stimulus checks, and look, all these things are going up. Crypto's going up, AMC's going up, the meme stocks are going up, S&P going up. We're covered off the lows. They don't know that the Fed's going. They don't know, right? Got to tune that out. Okay, be careful with that. Other investors choose to forget the severity of bear markets. They just, oh, this is different. This time is different. The people will try to reason irrational beliefs about the market, and that's just typical. Be careful about this. They also have no idea that the Fed drives the markets. Um, I would say avoid being influenced by these people. Do your own thinking on this. Try to look at what's actually going on with the markets. I would even be concerned if the market rallies back up and tries to make a second high, to be honest with you. I just think what we're seeing now is so different. And understand that the Fed rules these markets. So if the market can't respond to what the Fed is doing, um, it's going to be a problem, at least now. Now, the Fed's going to do something crazy probably at the end, which we'll get to. But for now, the Fed's going to keep coming in and trying with the current set of tools that they have. But remember, they can just come up with more tools in the future. So just keep that in mind. That's tip number 8. So just kind of the psychology of it, to understand that more and more people are going to be throwing more and more tantrums, especially the bulls, as this starts to come down. And there's that entitled feeling. Hey, I've just put my money in the ETF. The market's going to keep going up because the market always goes up, etc. So just be careful about that. Tip number 9. Tip number 9 is avoid the big short mentality. So everybody seen the movie? So this was the Big Short, which was about the 2008 financial crisis. So, excuse me one second there. All right, taking a drink of water. The Big Short mentality is that you're going to just stick it to the institution, and that it stirred the imagination of a lot of people about profiting in bear markets. 2008 was probably the last time I think you're going to see a bear market just continuously go down for a long time. I think what we're going to see now is more of like a flash crash type of a situation where you get these declines and then the Fed comes in, chop, 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 decline, the Fed comes in, chop. You're probably not going to see like a big short anymore. In 2000, pre-2009, market crashes occurred in large spikes without Fed intervention. So this fantasy, it probably cannot come true anymore. You're probably going to see more intermittent spikes down. The Fed chops it back up. The intermittent spikes down. The Fed chops it back up. You're going to see this choppy, crazy mess. So the fantasy is getting it all in one shot. That's a problem. The fantasies of that's a problem because it causes people to over leverage and it causes people to have unrealistic expectations. So with the Fed, it's more of a piecemeal situation. Okay. So we got to be smart about this because you're going to see declines and then you're going to see the Fed come in. You're going to see declines and then you're going to see the Fed come in. And then you're going to see probably some pretty crazy stuff with the Fed eventually. So I think avoid that mentality. Avoid it. Okay, this isn't your only chance to make it because the Fed's probably going to make it, so it's going to be really hard for you. Now, the next 3 slides are going to be the most important of this presentation, so I want you to really pay attention to the next 3 tips. Okay, we got tips 10, 11, 12, and then I'm going to do some question and answers. People have written me questions, so I'm going to start answering questions at the end of the webinars that people ask me. Okay, here's this next slide is probably the most important topic of the whole presentation, okay? So pay attention. Okay. Now for those of you who sail boats, okay, tip number 10, use storm sails to control risk in high volatility situations. Now, for those of you who sail boats, when a boat sails in a storm or a gale or a hurricane or anything like that, I don't know about a hurricane, but gale force situations, they use a very small sail, okay? Now, this is important because in high volatility situations, if you're expecting a high volatility situation, you should be trading smaller, not larger. Okay. You will not be able to handle the volatility swings. Like we've seen recently, the market could be bouncing 100, 200 points in just a few days, right? If you are leveraging in, the chances of you picking the right spot to get in, to get out are low, right? So trade small if you're expecting a large move. Use a storm sail. That's why boats use smaller sails when the winds approach hurricane force. Do not try to leverage everything in if you're expecting volatile situations. Because if you're using stops, you're going to get stopped out. If you're using too much leverage, you're going to hit a margin call. If you're trying to time it with the puts and the calls, if you don't time it right, that's a problem. It helps you keep a clear mind, and it helps you handle volatile swings. Okay? I cannot emphasize this enough. Be careful about this. Try to trade small. I know it's tempting. I know everyone wants to put all their, they think this is it. This is the big short. Don't think like that. We've got a Fed in there. We've got all kinds of landmines in there, okay? So you want to have a clear mind. Clear mind. You're not going to have that. Look, when things go wrong, you should be simplifying, not making things more complicated. If you trade small, you can hang in there. Okay? If you don't, you cannot handle the volatile swings. Okay? And the last thing here, bear markets will not behave in a rhythmic pattern. They will not behave in a rhythmic pattern. So if you are used to the bull market and I have my stop here and my limit here and it just everything's working fine and then, you know, the volatility is 25 points a day and then your volatility now is 150 points a day, it's not going to work. Okay? You must be able to handle unexpected twists and turns. So the word unexpected in here is critical in a bear market. Things can come out of the blue. Boom, you can get a big rally and then it ends and it comes back down. So just be careful. Be able to think clearly. Don't try to do the big short. I'm just telling you, not in this day and age. Maybe in 2008 you could do it. Maybe in 1987 you could do it. When you're talking about flash crashes, you're talking about Fed, you're talking about I mean, things get crazy. So trade small, keep a clear mind. If you're expecting high volatility, if you expect, these moves could be coming at 300 or 400 points at a time on the S&P. So use a storm sail. Otherwise, you're going to be capsizing that boat. Okay. Or you're going to have to keep getting in and getting in and getting in and getting stopped out, getting back in, getting stopped. So trade small. You can handle higher volatility, right? And you're going to think clearly. And so that's the key. Okay, next one here. This is another one. Avoid man-made time constraints. This is important. The market will decline on its own timetable, often not to expectations. So the market always keeps you guessing. You may think that you know when the market's going to go at a certain point. The reality is we don't. The market goes down when it wants. The Fed comes in, the Fed stimulates all of this strange stuff happening that is basically chaos theory. The Fed will cause delays, time delays in a decline. So avoid setting time constraints on yourself that are too close to, like if you're, giving yourself like a week or 2 weeks or something really short for something to happen, because the Fed can come in and delay it. I mean, ultimately the markets may beat the Fed and go down, but you don't want to be dealing with like unmeetable margin calls because you think that's the top, and then the Fed comes in one more time and delays it, and then eventually you would have been correct, but you can't make it, right? And then the other one is option time expirations. Look, options have a lot of good functions. Okay, they can work. You can leave it alone. There's a fixed risk. You don't have to use stops. It's got a lot of really good upside in terms of like trading or crash. But the downside is that if you time it and you think something's going to happen in a week or 2 weeks, and then it happens in 2 months, you may not make it there. So I would just say be careful about that. Give yourself some time. If you think something's going to happen, try to give yourself some time. Man-made time constraints it's a tragic thing when they happen. Uh, if you're trading small, if you need to do a call, you can do it. If you put it out a couple months on the option, you give yourself some time. If you do it a week or 2 weeks out, that may not be enough time. So these are self-made time constraints. Be careful with that. You want to think clearly. Remember, the more constraints you put on yourself, the more distorted your thought's going to get. You can't think clearly, right? You want to just trade small. Storm sail, guys. Storm sail. This is why the boats do it, so they can sail and they don't capsize, right? Same thing with the trading. You don't need to do this. You don't need to do this just because the market might go down a lot. You don't need to do this. So I'm trying to give you some practical advice here in terms of this. So that was my last second to last slide here. But just be careful with this. Now, last slide is the most important one after the storm sail one, but it bears warning. Now, I talked about the bulls getting aggressive, but there will be a time where if we get a severe decline, that the bears will get aggressive. And so it may look, if the market has this big plunge, like the Fed has lost control. But my last slide is, even in a severe decline, don't underestimate the Fed. Okay, so I put my picture of Darth Vader here. Don't underestimate the Fed. The Fed may fail in the short term, but they will lose some battles. Okay, they may not hold that 4,300 line. We may get a big decline, but long term they will win. Okay, and I'm saying long term, maybe in a year, maybe in 2 years, whatever. They will win. Okay, so don't underestimate the Fed. Okay, long term. And the short term, they may have issues. It looks like they're starting to have issues. They will come up with crazy new policies. This will happen. I promise you. We've already seen it. We saw it during COVID. They came up with crazy new policies. A couple of examples. Remember, they were talking about doing the $1 trillion mint on the coin. They'll probably do that, right? They'll do something crazy like that. Outright buying of stocks and ETFs. I don't know if you remember this, but during the 2020 financial crisis, they kept increasing more and more and more emergency lending facilities and operations and all this different stuff going on. And the talk, remember they were buying corporate bonds and all kinds of strange bonds. The next talk was, we're going to start buying stocks and ETFs. That was on the table. There were articles about it. You can look it up. If we do get a big decline, they will come in and do something like that. So don't underestimate them. They will come in and start buying the market outright. Like outright, forget about the Fed juice behind the scenes. They will outright buy stocks and ETFs at some point. if this thing goes down too much. So I'm trying to give you different perspectives, but in the long term, they're going to win. They're going to win. So, right now we're looking at the short term. I think that the markets have a chance to come down, but long term, don't get too cocky on the other end if this thing starts going down, because um, they'll figure it out. They always do. Okay, so just keep that in mind. All right, so let's talk about the current S&P situation. I know we're getting a little bit long here on time. So current S&P situation. So here's where we are now. So current S&P situation. We have a huge response from the Fed here on the short term. You can see that on the short term that the Fed has just completely surged on this market in the last week. This is a very short-term hook. You can see they did a 180 on this, and the Fed is trying to stop that event horizon that I talked about. Now, the question is, look at the amount of energy they had to put into this just to get this to do this, right? That is crazy. Now, the question is, will the Fed keep going higher and higher, or will they bend over here? I think with the taper coming, I think they're going to be somewhat limited on this, but you can see this was not the market bouncing on its own. This is not the market bouncing on its own. This was 100% the Fed. So just keep that in mind, and keep in mind how much they had to put into it. And so this is the calculus that I tell you about. You got to weigh everything. Given this much information, given this much push, that's not very good. Here's another viewpoint of it here. This is just with a little bit of a darker background, but you can see this is the fastest response in the history of the Fed juice. So what they did in the last 3 days is the fastest response in the history of the Fed juice. They went from almost they were pulling back severely to almost back up to full speed. Now, these are very, very short-term operations. There's longer-term operations that still are way lower than they were up into here, right? So this is why I talk about the damage being done here. There was a lot of damage done into here that I don't think that they're going to be able to just wave a magic wand and fix that. Okay, there's a lot of damage into here, but you can see they responded. So this is what I'm saying. You can't just wave a wand and say, well, here's my forecast, because they're going to come in and do this. And so this is what makes it complicated. I still think it's going lower. And again, I give the specifics to the subs and the newsletter and all that information, but this is what happened. Okay. This is another one. This is an intraday. This is a 4-hour chart. This is a stochastic here. So you can see here, each of these bottoms here, this was the Fed each time coming into here, completely stopping this decline every time it hits this event horizon level. The stochastic on the 4-hour chart just went up to 96.6. That's pretty high for a 4-hour. So it appears that we're coming into some type of a topping pattern into here on the 4-hour chart. But you can see there that that is the power of the Fed, at least on the short term. Now, again, I think that they're having issues here, but that was stopped by the Fed. Now here's one other slide here. This one is pretty telling. This is the dollar juice here. See, the dollar juice is essentially, it's been in the sell since 712, and then it goes back into a sell again on 813. Notice this trend line here. This trend line is decreasing, and the market comes up once and tested. It came up and tested the trend line again. Trend line retracements are very powerful. They happen a lot in bear markets where the market's trying to come back up and rally. So far, it looks like it stopped there, at least on Friday. Notice the dollar juice is still in a sell. The polar R squared is right up there at the high. You see it's hitting that high up there. So still a lot of indications here that the market is having issues. Okay, so that's what's going on right now. Now let's do some Q&As, okay? So this is a question. So someone sent me an email. I sent out a chart on oil. It said this was oil. Here's what it's doing. So they said, can you explain this oil chart? So I'm going to explain this for our viewer who wrote me this question. And if you guys have questions, you can email it to me and I'll answer them in the presentations. So this was the chart that I sent out on oil. And the red arrows are the Fed juice, and the green arrows are the double lunar, and the dark arrows the solar cycle. So let's talk about the Fed juice first. So Fed juice first here. This is Fed juice here. These are the red arrows here. So this is a buy, this was the sell, this was the buy. It's been in a buy since 9:14, so it's picked up a lot of this, it's picked up most of this rally into here. So that's the trend, which is the Fed juice. Now the green arrows are the double lunar cycles, so that's what this is here. So these green arrows also work with that. So sometimes when you line those two up together, they can work very well. Down here is the double lunar cycle in terms of the analog. And then the Fed juice is down here. This is the actual Fed juice here. That corresponds to this, this red arrow here. And then this is the best RSI pressure here. So when this hits certain levels, that gives you short-term buy and sell pressure into there. Okay, so that's just an example. But the Fed juice has been picking this up very nicely. So this is in the energy newsletter. So I just picked this chart because it's looking very nice right now. Next question, do you think Apple is a buy? Do you think Apple is a buy? So that's a question. No, I don't. The Fed juice has been in a sell since 9/1. So for those of you in the stock ETF service, you've seen this. The Fed juice has just been holding in an incredible sell pattern, and it's been holding very steady here. So it was in this sell even when it looked like it was doing this fake breakout here, and then it just kind of fall down here. Now notice Apple did a very strong topping pattern into here. You had 1, you had 2, you had 3, you had 4, you had and then you had a false breakout, and then you had a decline here. So 1, 2, see if you can see that on the screen. 3, looked like it was doing a quadruple top, and then it looked like it was breaking out, but the Fed juice goes into a sell here, and it stayed into the sell the whole time. Okay. Remember I talked about the lunar cycle as being something to look at. Look at this lunar cycle here. Look at this. You see how the lunar cycle goes up like this and then falls down, and then the 4 to 6 day cycle falls down like this. Look at this. You see how it follows that? So when I gave that tip number 2 or 3, I think whichever one it was, follow the lunar cycle. These things are good. They, like, to really give you an idea in terms of what's going on. And even this little dip into here corresponds to this dip into here, and this bounce into here corresponds into this bounce into here. I mean, all of this stuff is given to you ahead of time. So you guys know this ahead of, this isn't a stochastic based upon price. This is the actual lunar cycle. So I actually covered this up, but just to give you like some proof here that this is a real cycle. This looks like a stochastic, but if I move this out, you can see this actually forecasts out into the future. You see that? I'm just covering this up because of the YouTube. It's not subscriber content, but all of these cycles go out into the future. So this isn't just a stochastic of price. This is what's going on with the double lunar cycle and the 4 to 6 day cycle. So anyway, so that was my, no, I don't think so, because I'd like to see that Fed juice getting back into a buy pattern on Apple. So no, it's been in a sell since September the 1st, and those of you who have been in the stock ETF service have been able to capitalize on that. Apple's been one of the better performing ones. I mean, they're not all this good, but that was the question. Okay, next question. This is not related to stocks, but how is the McDougall diet going? So for those of you who remember, I did a presentation, like, I don't know, it was a little bit over a month ago, and I talked about diet for traders, like that, you know, you need starch, you need carbs to be able to think. And so we talked about the McDougall diet. So I've been on this McDougall diet, which is basically high starch, low fat, and I've been losing a lot of weight with it. So I'm going to answer that question here. So this is my weight loss graph here. I plot this every day. I was about 220 here when I started this McDougall diet. This was back here in July. So we're about 3 months into this. Now, the thing about this diet is it's like a very steady weight loss. It's not anything super dramatic. I think a lot of diets that you go on, you see like a big plunge down and then you gain the weight back. This diet has been just a very steady weight loss. And I have tons and tons of energy on this. So yeah, that's kind of a random question. But you know, people want to know on my progress on the McDougall diet. So yeah, so I feel great. I eat whatever as much as I want in terms of carbs. I just eat carbs all day and starches, and it just, the weight just keeps coming off. It's amazing. It's just the easiest diet I've ever been on to follow. So I know it's not trading related, but I thought I would answer that question. Next question is, here's the question. If the Fed is responding, then why won't the market why won't the market keep going higher to new highs? So that's a good question. So the question is, if it's a very good question. The Fed's responding. The market's always gone back to the highs in the past. Why won't it go to a high now? Okay, so let's answer that question. Um, okay, here's why I think it won't go back to the highs. So the Fed has caused severe damage with the pullback. I talked about that since 7.6. So it's not like that they had a little bit of a pullback on the market. They had a major pullback and a severe pullback. So when we go back into here on this chart here, this was the major pullback. So for those of you just joining us, I see that the viewers are jumping up and down. I'm Shane Smoleny from Wolftrader Futures. We're just wrapping up a webinar here on tips to trade in the bear market. But if you want to see the replay of this video, I will have it shortly posted. I'll send you guys out a link. If you're not a subscriber, go ahead and subscribe to the channel, like the video. I would appreciate that. And the question was about if the Fed keeps ramping, why won't it keep going to new highs? Well, because they had such a severe pullback here that they can't just spike it up for 3 days and fix everything. They've caused a lot of damage here. So that's the first part to that question. Okay, so the recent surge, here's the next part. The recent surge has paused the selling, but the market is now resisting the Fed for the first time since 2009. This is a big one. I've never seen the market resist the Fed. This is the first time I've seen it happen. So bang for the buck. How much is the Fed putting in? So how much is the market responding? Not that much. There are severe negative astro cycles right now. That's another reason why I don't think it's going to go back up. There's a December taper coming, which I think will happen. There's too much pressure right now with the inflation, especially with oil going so high. I don't think the Fed has a political will to do this. There's a lot of stuff going on right now, too, with all that insider trading. There's a lot of pressure on them right now. And then we're in an economic slowdown. I've showed this multiple times in terms of the world leading index. There's a lot why I don't think right now why it's going to keep going back up. So why could it happen? Well, it's always possible, but it would take a tremendous amount of energy at a time when the Fed is under pressure. So I just said that. So they could do it if they wanted to, but I don't think they're going to have the political the political tailwinds to do it. This is the last point I want to talk about down here. So even on a rally back to new highs, I still think we'd be under severe threat of a collapse. So even if they are able to push it back up, to inch back up, which could happen, guys. And remember, you're talking about crazy stuff here. I still don't think it's going to be enough. That's just my personal opinion. We're getting towards the end here with question and answers, so I will try to answer more here. So I see some comments here. I'll answer the comments in a minute, but. All right, so here's the next question. Where can I find the user guide? So I put a user guide on the website. So here's where you can find it. So if you go to the website, this is S&P. It's going to be under every single newsletter. I put this, but you see there's going to be a gray box here that says user guide. So you can go there and click that. And what it's going to do is it's going to open a page, and I'm still building it, still building, but it's going to have a bunch of question and answers where it will talk to you about each type of indicator that we have, like the day percent statistics. Like a lot of people want to know what that means and how to use it. How do you know the statistical patterns of each day? So you would go here, would answer it, the Fed use. So I kind of go through, and that's going to keep building and building and building. And the more questions that you guys send me, the better I can make this, because I can answer any questions that you guys might have. So I'm going to wrap things up there. I know this got a little bit long, but thank you guys for coming today. I will take some questions now. If you want to sign up for any of these services, I highly recommend that you go and at least try the free 7-day trial. It's going to be under Wolftrader Futures plans pricing, and you can go there and sign up and try the 7-day free trial. You'll get the daily updates. You'll get the monthly newsletter. Remember, on October 31st, the rates are going up. Okay, so now is the time to try it out. You can reach me at shane@wolftraderfutures.com, or you can go to www.wolftraderfutures.com or www.fedjuice.com. Those are the two website domains. They're the same domain that just points to the same place. YouTube, you guys are on Wolftrader Futures YouTube, so go ahead and subscribe to this channel, like the video if you like the content. Twitter is going to be at Wolftrader FUTU1. That's a lot to talk about, I know. So I tried to narrow the focus down to this. We do have other multimedia ways to reach us, but this to me this is the main focal point here. There is a free email list on the website, so go there and sign up on that so you can get news and events and notifications of things. So what I'm going to do now is I'm going to try to answer some questions here. Okay, Pat says excellent professional job on the slides. Thanks, guys. Yeah, I tried to change things up. I'm trying to give a different way to present things each week. But yeah, this was important because I think that the bear markets are so complex now with what's going on with the high speed trading with the Fed that you need to take all this into account. Um, okay, so thanks for the oil information. You're welcome. Yeah, I didn't even know who it was. Someone, yeah, it's Leon. Okay, Leon, you're welcome. Yeah, people ask me questions, and so I just say, well, I'll answer it in the webinar. So if you guys have questions, send me an email, and I'll address it each week. And anyway, so yeah, so I'm glad to see that people are having success on the McDougall diet. Hopefully, if you guys have any questions about that, that diet is incredible. I think just for health and longevity and energy, it's just really easy to keep the weight off there. So, uh, any questions that you guys have, go ahead and ask it now in the chat, and I'll try to answer this in any way possible. I know that's a lot of information. If you guys want to go back and look at this, like I said, I'll have a link for you. I'll send that out to you so you can see the replay of the webinar. So, uh, any questions here? Diet did not work for me, but cut out all sugar and fats, lost some weight, which has some great risks. Okay. All right. So that's basically it, guys. So I hope everyone stays safe out there. Have a great weekend, everybody. And I will talk to you soon. For those of you who are subscribers, I will be having a very important market update video this weekend where we talk about just what could be happening here in the next few days. I'm going to give you very specific days and points and dates. We are coming into a very turbulent period into here, so I just hope everybody stays safe out there. If you're not particularly bearish on the market, you can always just be safe, be in cash or lighten your positions or go into defensive plays. But I just trying to make everybody aware of this stuff because I just think that there is a significant risk at this time on the market. So that's basically it, guys. So everybody have a great weekend. Thanks for coming.